Let's get in Manish Vadhavan, Managing Director and Head of Interest Rates at HSBC, who now joins in on the show. Manish, two ways of looking at this downgrade by S&P. Nirmal said it's a wake-up call. Shankar Sharma said we should just nod and move on and pay absolutely no heed. Which side would you go with?
I think it's definitely an important message for the policymakers at the moment that we need to really do some introspection in terms of the subsidy burden and the overall macro numbers, which are a bit alarming, which is the current account deficit and the fiscal side, which is not looking too great at the moment. But I would not be alarmist at this stage and say that things are going out of hand. It's a very normal message from the rating agencies which has come in. I think we are standing at a cusp. It will all depend on what way we go from here. Some steps have already been taken to curtail the current account deficit. I think from that point of view, if I see it's not alarming, but definitely we need to pay some introspection towards this call.
Right, but Manish, given the high interest rate differentials that still exist between India and many other OECD markets, and the likelihood, or rather the hope, that the rupee won't fall further from here, do you believe that foreign investor interest in the fixed income markets will still hold up despite today's the ratings outlook change?
Judge, I would really agree with you that there is definitely some kind of a problem with this kind of a outlook change, because there are a lot of funds which invest according to the ratings allotted to the countries. But at the moment, the FI interest in debt, Indian debt, is not being governed by that account alone. There are so many other factors which have come into play. Primarily the kind of GAR regulations, because of which there is a lot of uncertainty on tax. There's a second issue of withholding tax. And thirdly, the more important one is there has been a circular which got released in January by SEBI, which has put some kind of restrictions prospectively on the trading side of the FI. So for the last 2 months, we have not seen much interest because of those reasons. This is an added pressure because of which things may slow down or things may not look so bright for the FIs to invest in India in the short term.
We did talk about foreign investors looking at a whole lot of other issues as well, apart from just a ratings outlook revision. Now, assuming we do have a situation where we head into a downgrade, possibly 9 to 10 months from today, God forbid that were to happen, do you believe that then would make foreign investors begin to change their view on India, at least in the fixed income markets?
Yeah, that can be one of the triggers if you paint that kind of a scenario, and if the probability what S&P is giving 1 out of 3, if that kind of a thing materializes, that definitely will have a negative impact. But I would still say, the FI investments in the Indian government debt is just 2% of the total debt in India. There are no meaningful investments in the corporate debt side. There's a lot of scope at the moment if we put our policies in place in the sense about the ease of entry and exit to the FIs and go away with this kind of an auctioning process. Because a lot of investors have questioned this, that anywhere in the world, why do you need to pay money to invest in your own, invest in our country? You need the capital flows. So why should we be paying money? So I think these kind of feedback has already gone to regulators. We expect some kind of a positive announcement on this aspect. But if you're talking about a rating downgrade, that will be a game changer. I can't predict what kind of a reaction will happen. But at the moment, what I would say is the investments in debt are so low that it would not disrupt the domestic markets.
Do you believe today's ratings outlook revision will be reason enough for some sort of movement in the bond markets, or do you believe the bond markets would continue to stay focused on the larger issue of the liquidity pressures that it's facing?
It's an added point which has hurt the sentiment in the bond markets. After the April monetary policy, we have seen yields spiked by at least 20-25 basis points. I think where we are coming from is it's a matter of demand supply, and there's a huge government borrowing program lined up for this first half of the year. So we are seeing that kind of a pressure. This has added to the pressure at the moment, to the sentiment which is negative, and overall, as you said, the liquidity pressures which are there in the system. So it is just an added factor which is, and in our view, the bond yields are hovering around, they may hover around 845 to 875 on a 10-year benchmark for at least next 3 to 4 months, unless and until RBI comes up with a large OMO buyback announcement or something of that sort. But this is how it is. But this is an added factor which is hurting the sentiment in bond markets today.
Now, one of the points, and we've been asking most of our guests on today's show about this, is the point about S&P talking about GDP growth in the current financial year likely coming in only at 5.3%. Now, how would you view that? Because that looks like, I don't know where they got this number from, but it looks, impossibly pessimistic.
No, I would also agree with you that I think they have taken the worst of assumptions for the GDP growth for the year and the worst of assumptions for the fiscal deficit. I am actually not so pessimistic on growth. We could argue that instead of 7.3%, whether it will be 6.75 or 7%. I don't think the growth credentials have gone so bad in terms of what is going on. We still have a government which is talking about curtailing the fiscal deficit. So on that account also, if we presume that instead of 5.1 it's 5.3 or 5.5, it does not change the big picture so much that it warrants a downgrade of growth to such an extent. So I think they have taken the what would I say, a scenario or probability which is very low in my opinion.
Sean, you are also seeing some sort of stability which is creeping into the markets as we speak. So after having hit a low of close to 17,019 for the Sensex, we've recovered somewhat marginally, as has the Nifty. But Manish wanted to bring it to the point of weakness. Do you think that all of the sectors of the economy are vulnerable to the kind of weakness that we've seen, and that we are likely to see things getting worse before we see growth moderating, and that it'll probably hit its potential only until we're well into 2013?
However, I would take it like this, that the important message for the government at the moment is that we need to react on controlling the fiscal deficit and give a very serious message to the industry and to the economy overall, as that we are in a serious business of containing this fiscal deficit. That definitely means that we need to raise the prices of petroleum, and we should not let the subsidy target of 2% of GDP overshoot. That is one important thing. Second thing is on the current account deficit, because I can comment on the macroeconomic parameters. We really need to take some actions, policy actions, wherein we allow and invite more and more capital flows into the country. If these two things are set right, I think everything will start following, because if we are able to contain the fiscal deficit, then we will definitely see some kind of a further monetary easing by RBI in the months to come. And on the current account also, if you are able to generate or invite more capital flows, it'll give some kind of a semblance to rupee dollar market also. These are the two main things which are important at the moment. I would feel that from a macroeconomic point of view, if these two things can be handled well, the impact on the specific sectors of economy, whether it is banking or the other real sector also, things will start stabilizing. The underlying parameters of growth in India have not run away, have not gone away. You need to take some kind of a policy action, and then you can see the reaction automatically. So I would not be so pessimistic on growth. I don't agree with the opinion of S&P at the moment.
Right, Manish, now just over the last 10 to 12 days we've been seeing the rupee under a fair bit of pressure, and there's been this constant buzz that keeps coming out of the forex markets that you saw some amount of indirect intervention by the RBI. Some public sector banks were seen selling, and things like that. At the same time, we've seen the liquidity deficit climb back to above above 100,000 crores, despite the cut that we saw in terms of CRR over the 80,000 crore release that we saw, and the fact that the RBI said that liquidity levels or the deficit seems to be coming in line with what it's been targeting. Is this somewhere reflective of the liquidity deficit once again climbing back to levels that we saw earlier, as the RBI tries to protect some sort of level for the rupee?
I think there are two separate questions here. Number one, whether RBI has been intervening or not, it's a very difficult question. I really don't know. You can expect that at a certain level, definitely there could have been some kind of intervention. But as far as liquidity is concerned, the prime reason for liquidity getting into such a big shortfall has been the currency expansion in the first fortnight of April. This is a very seasonal factor which happens. There's a lot of cash outflow in the months of April and May from the banking system, primarily on account of FCI drawdown of the money from the system, from the banking system, which they use to purchase the grains, etc. That is one reason. And secondly, I think what RBI has said, the liquidity will remain under the ±1% because there is a large redemption coming in the first week of May. So I really don't see a possibility in the next 3 to 4 months that liquidity deficit will go out of hand or we reach the same numbers what we saw in November, December or mid-March. Unless and until, again, this is a caveat that RBI has to heavily intervene in the dollar-rupee market and, supply dollars, which can create that kind of a stress. But on a big picture view, I would say the rupee move is reflective of the current account deficit, and that's why this kind of a trend is going on. It's very difficult to give a target. It's very easy to say that 55 could be the next target or something of that sort. But I think with some kind of a policy tweaking and some kind of measures to get around the inflows in the dollars, it can change the big picture quite soon.